They want you to believe silver collapsed because of profit-taking. They want you to believe $11,000 evaporated in a single day because traders got nervous. That explanation is comforting. It's also false. This wasn't volatility. This wasn't sentiment. This wasn't fear. This was pressure applied deliberately at a specific moment in the paper market to enforce a narrative that no longer matches physical reality. And the timing tells you everything. Silver didn't fall because demand disappeared. Silver fell while demand was accelerating. That contradiction alone should stop you cold. Because markets don't move on opinions forever. They move on physics. And physics doesn't care what CNBC needs to print. What you witnessed was not a crash. It was a containment event. Paper contracts were dumped with precision, not randomly, not chaotically. They were deployed in size in a thin window, where liquidity could not absorb them without breaking price. That's not a sale. That's a signal. A message sent to the market that says, do not look here. Do not ask questions. Do not follow the metal. But here's the problem. You cannot suppress chemistry. Silver is not a story. It is an element. It sits on the periodic table. It has properties that cannot be negotiated away. This isn't theory. This is published data. Silver has the highest electrical conductivity of any metal known to man, the highest thermal conductivity, the highest reflectivity. You cannot cheat the periodic table, and you cannot build a modern industrial system without silver. The lie is that silver is a precious metal. That framing is outdated. Silver is an industrial bottleneck with a financial disguise. Every solar panel requires it. Every advanced circuit requires it. Every EV, every AI data center, every weapons system quietly depends on it. And here's the part they don't want you to dwell on. Unlike oil, unlike copper, unlike iron, silver is consumed. It does not get recycled efficiently. It does not come back to market at scale. Once it's embedded in circuitry, coatings, chemical processes, it is gone. Permanent demand. Irreversible consumption. And now look at supply. Silver is not primarily mined for silver. It is a byproduct. A secondary output of lead zinc, copper mining. That means silver supply is not responsive to silver price. You can double the price tomorrow and production barely moves. This is the math they refuse to run. You don't get new silver supply by incentivizing miners. You get it only if base metal demand explodes. And even then, it takes a decade. Permitting. Exploration. CAPEX. Geology. Long timelines. Rigid supply. Now overlay that with what just happened. The world crossed an industrial threshold quietly. AI data centers went from experimental to mandatory infrastructure. Grid-scale solar moved from subsidy, driven to geopolitically enforced. Military procurement pivoted to electronics-dense systems. Silver demand didn't spike. It locked in. This is not cyclical demand. This is structural. And yet, the price was smashed. Why? Because the paper market still pretends silver is a speculative asset, not a critical input. Paper silver is infinite. Physical silver is not. So when physical demand tightens, the only way to maintain the illusion is to lean harder on paper. More contracts. More leverage. More synthetic supply. Until one day the math breaks. We've seen this movie before. Not with silver, specifically, but with commodities that crossed from optional to essential. The analysts were a decade late. The charts lagged the labs. The headlines followed after the damage was already done. The lab always leads the chart. Right now, refiners are reporting longer delivery times. Fabricators are locking in supply months ahead. Industrial buyers are not price sensitive anymore. This is the most important shift, and almost no one is talking about it. When a buyer stops caring about price and starts caring about availability, the market has already changed. The price just hasn't caught up yet. So what does an $11,000 paper drop actually mean in that context? It means someone needed price lower, not because fundamentals weakened, but because fundamentals strengthened too fast. Lower prices discourage retail accumulation. They shake out weak hands. They buy time. Time for institutions to reposition. Time for supply chains to adjust contracts. Time to secure physical inventory quietly. Institutions are always late, but they are not stupid. They react after the data becomes undeniable. And when they move without asking for permission. This was not an accident. It was a controlled release, because here is the reality they are trying to manage. Global silver inventories are thin relative to consumption. Above ground stockpiles are smaller than reported. Much of what is counted is already spoken for, and new supply is not coming fast enough. You cannot scale mines like software. You cannot print metal. You cannot optimize geology. This is inevitability, not speculation. Short-term price action exists to distract you from long-term constraints. Paper tells you silver is weak. Physical markets are telling you something very different. Ask yourself a simple question. If silver were truly abundant, why are industrial users signing longer-term contracts at fixed volumes? Why are refiners prioritizing certain buyers? Why are premiums quietly rising in physical channels while spot price falls? Narrative versus reality. Price versus fundamentals. This gap does not close gently. It closes violently. And the people who get hurt are not the ones who were early. They are the ones who trusted the screen instead of the system. This is not about predicting tomorrow's price. That's noise. This is about recognizing that the market is mispriced relative to physical law. Mispricing does not correct on your schedule. It corrects when pressure exceeds tolerance. And pressure is building. Look at energy policy. Look at electrification mandates. Look at defense spending curves. All of them point in the same direction. More electronics, more conductivity, more silver. At the same time, ore grades are declining. Costs are rising. Environmental constraints are tightening. This is not a setup that resolves downward. The crash you were shown was psychological. The scarcity unfolding is physical, and physical always wins. People fixate on the dollar value of the drop. They miss the signal embedded in the behavior. If silver were irrelevant, it wouldn't need to be controlled. If silver were abundant, it wouldn't need to be smashed. The effort itself is evidence. You don't suppress what doesn't matter. Right now, the market is offering you a discount dressed up as fear. Not because the future is uncertain, but because the future is becoming too clear. This is the last phase before repricing, where disbelief is engineered, where confidence is shaken deliberately, where patience is tested. The audience that understands this doesn't need reassurance. They need clarity. Ignore the noise. Ignore the intraday candles. Ignore the talking heads explaining away what they don't understand. Focus on flows. Focus on constraints. Focus on what cannot be faked. Paper can move price for a while. It cannot create atoms. Silver is being consumed faster than it is replaced. That equation does not resolve itself. It compounds. The longer the suppression, the sharper the release. And when the market finally acknowledges what the supply chain already knows, the adjustment won't ask for permission. It never does. What you're watching now is not the end of the story. It's the point where denial becomes expensive. Events are already in motion. Contracts are already signed. Metal is already spoken for. Price will follow, not because people believe, but because physics insists, and physics always collects. The mistake most people make is assuming repricing is an announcement. It isn't. It's a realization that arrives late. By the time the price reflects reality, the opportunity has already passed. The easy positioning is gone. The calm accumulation window is closed. Right now, the system is still pretending it has control. Paper volume still dwarfs physical volume. Algorithms still trade narratives instead of molecules. Risk desks still model silver as if it were ornamental, not operational. That illusion survives only as long as delivery pressure stays manageable. And that's the fulcrum, because every industrial user knows something retail is rarely told. You don't need everyone to demand metal. You just need the wrong buyers to demand it at the same time. Silver is not oil. There is no strategic reserve that can be tapped quietly. There is no swing producer waiting in the wings. When inventories tighten, there is no release valve. There is only rationing, and rationing doesn't show up as a headline first. It shows up as delayed shipments, as force majeure clauses, as priority allocations. Those signals are already appearing at the edges. Not loud enough for the news. Not clean enough for analysts. But unmistakable to anyone inside the supply chain. This is how shortages actually form. Not with panic. With paperwork. The dangerous assumption is that institutions are in control. They aren't. They are managing optics. Their job is to prevent feedback loops, to slow reflexivity, to keep price from revealing stress too early. That's why price is pushed down when fundamentals improve. It buys time. But time doesn't create metal. It only reallocates who gets it. And the relocation is already underway. Long-term contracts are being renegotiated quietly. Industrial buyers are locking volume, not price. They don't care what the chart says. They care about continuity of operations. A solar manufacturer cannot halt production because silver spiked. A defense supplier cannot miss delivery because inventory ran out. An AI data center cannot throttle capacity because a metal became scarce. They will pay whatever clears supply. That's not speculation. That's operational necessity. This is where the paper market loses relevance, because paper exists to manage perception. Physical exists to keep systems running. And when those two diverge far enough, paper yields. Not gradually. Suddenly. The crash you saw was a psychological maneuver. The repricing that follows will be mechanical. No emotion. No drama. Just bids chasing availability. This is why volatility increases near inflection points. Control becomes expensive. Leverage becomes dangerous. Every suppressed move increases stored energy. When it releases, it doesn't retrace politely. History doesn't repeat, but it rhymes. And the rhyme here is familiar. An asset dismissed as obsolete. Underinvestment justified by false narratives. Demand shifts structurally. Supply lags fatally. Then one day the math becomes public. Not through a press release. Through a scramble. By the time consensus changes, positioning is no longer optional. It's compulsory. And compulsory buying is what resets prices. You don't need to predict the exact moment. That's a distraction. You only need to recognize asymmetry. Downside is paper-driven and temporary. Upside is physical-driven and permanent. That's not opinion. That's how constrained systems behave. The calm voice telling you silver crashed is the same voice that will later tell you it unexpectedly surged. Unexpected to whom? Not to geology. Not to chemistry. Not to the engineers quietly designing systems that cannot function without it. The market is late because it always is. The lab already ran the experiment. The result is known. Silver is no longer priced as a consumed industrial necessity. That gap is the opportunity. And gaps like this don't stay open forever. There will be a day when price no longer reacts to paper selling. When dips stop dipping. When volume spikes fail to push it down. That's not bullishness. That's exhaustion of suppression. When that happens, explanations will scramble to catch up. New narratives will appear overnight. Suddenly silver will matter again. By then, the calm accumulation phase will be over. Right now, the noise is designed to make you doubt timing, to make patience feel foolish, to make inaction feel safe. That's always the trick. The real risk is not volatility. It's misalignment with reality. Events don't wait for belief. They unfold on their own schedule. Silver doesn't need a story to reprice. It needs delivery requests to exceed inventory. That moment is closer than it appears on a chart. Nothing about this is accidental. Not the drop. Not the timing. Not the silence. This is how transitions look before they become obvious. Quiet pressure. Managed perception. Sudden inevitability. You don't need to convince anyone. You don't need confirmation. You just need to understand what cannot be reversed. Demand is locked in. Supply is constrained. Time is non-negotiable. The system will adjust. It always does. Calmly, relentlessly, without asking who is paying attention. And when it does, the crash everyone remembers won't be the one that mattered. The real move will be the one they didn't see coming.